Okay, let's talk about Form 1099-K. If you've sold anything online, used an app like Venmo or PayPal, or done any kind of gig work, you've probably heard about this form. And let's be honest, for the past few years, the rules around it have been a total headache. But that's all changing for the 2025 tax year. So, we're going to cut through all that noise and give you the clear, simple facts you need. If you felt a little bit of that tax anxiety creeping in when you hear 1099-K, trust me, you are not alone. The rules have been a moving target, to say the least. But the good news is, for 2025, things have finally settled down. And in this explainer, we are going to make it all crystal clear. So here's our game plan. First, we'll take a quick look at the 1099-K roller coaster, just so you understand why everyone's been so confused. Then, we'll nail down the final official threshold for 2025. After that, we are going to tackle the biggest question of all, what to do about selling your personal stuff. I'll show you exactly how to report it on your tax return, and we'll wrap it all up with a simple action plan. Sound good? Let's do it. All right, to really appreciate how simple the new rule is, you got to understand the chaos that came before it. It's a whole story of new laws, last-minute delays, and, a ton of confusion for regular people just trying to do their taxes. So this wasn't just random. This all started back in 2021 with the American Rescue Plan Act, or ARPA. It tried to drop the reporting threshold way, way down. The idea was to get a better handle on the gig economy. But the change was so huge that the IRS basically had to hit the pause button more than once to keep from totally overwhelming everybody. And this slide, wow, it really lays out the whole wild ride. For years, we had the classic rule, over $20,000 and over 200 transactions. Then, bam, ARPA planned to drop it to just $600. Can you imagine? After a bunch of delays, the IRS suggested a compromise, a phase-in starting at $5,000 for 2024. But then, new legislation swooped in and just hit the reset button, taking us right back to where we started. Okay, enough history. Let's talk about right here, right now. This is the only rule you need to worry about for the 2025 tax year. That's the return you'll be filing in 2026. So what was that new legislation? It's called the One Big Beautiful Bill Act, or OBBBA. And it did exactly what so many people wanted. It completely reversed those ARPA changes and brought back the original, much higher threshold. This was a huge sigh of relief from millions of people who just sell stuff on eBay occasionally or use Zelle to split a pizza with friends. So, for 2025, a payment company only has to send you a Form 1099-K if they processed more than $20,000 for you. And I can't say this enough, this little word is absolutely critical. It's not one or the other. Both conditions have to be met. So it's over $20,000 in payments. You had more than 200 separate transactions. If you're under either one of those numbers, you're not supposed to get a 1099-K. It's that simple. Now, let's be super, super clear on this next point. This is really important. The new rule changes who gets a form. It does not change what counts as taxable income. The law is still the law. You are legally required to report all your taxable income, whether you get a piece of paper for it or not. Okay, let's dig into the number one cause of 1099-K stress. You cleaned out your closet, sold some old clothes or furniture on Facebook Marketplace, and now you get this form in the mail that makes it look like you're some kind of big shot business owner with thousands in profit. Don't panic. It's not as scary as it seems. The IRS has a really clear line here. If you sell a personal item for more than you originally paid for it, say a collectible, that extra profit is a taxable gain. But if you sell it for less than you paid, which, let's be real, is what happens 99% of the time with our used stuff, that money you get back is not income. And just as important, you can't claim it as a loss on your taxes either. And this example just makes it so clear. You bought a nice fridge a few years ago for $1,000. You sell it online for $700. Your 1099-K might show that $700, making you think, oh no, I have to pay taxes on this. But you actually lost $300 on the deal. So that $700 is just you getting some of your original money back. It is not taxable income. So the big question is, how do you tell the IRS that the money on your 1099-K isn't actually income? For years, this was kind of tricky. But now the IRS has created an incredibly simple, direct solution. Recognizing how much confusion was out there, the IRS actually went and redesigned part of the tax return specifically to handle this exact situation. It's their way of giving taxpayers an easy off-ramp. And here it is. This is the magic bullet.
Right at the very top of Schedule 1, that's the form for additional income and adjustments to income, there is a brand new box, and it says exactly what it's for. Reporting amounts from a 1099-K that were for personal items you sold at a loss. And the process, honestly, could not be easier. Step 1, add up the gross amounts from any and all 1099-Ks you received for selling personal stuff at a loss. Step 2, put that one single number in that new box on Schedule 1. Step 3, well, there is no step 3. You're done. The IRS computer now sees that amount and subtracts it so it won't be counted as taxable income.
Now, just a quick note for the tax pros watching. Yes, you could still technically report these sales on Form 8949, but for the vast majority of people just selling old stuff from their garage, this new Schedule 1 method is the simplest, most direct way to get it done right. Okay, we have covered a lot of ground, so let's boil it all down into a simple action plan you can take with you. These are the absolute key things you need to remember. First, burn this into your brain. The 2025 threshold is over $20,000 and more than 200 transactions. Second, remember that if you sell a personal item for less than you paid, it is not taxable income. Third, your new best friend on your tax return is that little box at the top of Schedule 1. Use it. And finally, and this is probably the best advice of all, keep good records. If you can, find old receipts or bank statements so you can prove what you originally paid for things. And that really brings us to our final question. The new rules are a huge relief, and they mean fewer people will get these forms. But the one thing that never changes is your responsibility to track your own finances. Good record keeping isn't just about taxes. It's about being in control. So the question is, are your records ready?